Can you just quickly remind us the net return of your fund last year?
Approximately 47.5% net return.
Pasi, hello, thank you to be here. For those who don't know you, can you quickly introduce yourself?
Thank you, Remy, for inviting me here. I'm a portfolio manager at Helsinki Capital Partners, and I'm also one of the partners in the company and also member of the board.
All right. First question for my audience. How did you become one of the best fund manager in the world in your field last year?
Yes, last year was tremendously good, especially for our HCP Quant Fund, which delivered a net return of 47% last year, which is amazing. And well, how did this happen? There are a few reasons behind it. First of all, it is a value fund and it's also investing in small cap value stocks specifically. And we are very concentrated in our approach, which means that we also very heavily weighted on the value side. Like if usually a value fund holds like 100 or 200, might even hold 1,000 stocks, we are like on 20 to 30 stocks in there. So basically like what happened last year was that in the market, generally we got the rotation from growth stocks to value stocks. And because we have so much weight on the value, it benefited us much more than our average value fund. So what happened was then that our HCP Quant Fund was in a small and mid-cap category ranked by Citywire. It was the #1 for the last year. It was an excellent return.
Yeah. Can you just quickly remind us the net return of your fund last year? You said it, but just to remind my audience your return.
Approximately 47.5% net return, which means after all expenses, fees and everything, yes.
After the expenses fees?
Yes, so it's a net return, not gross return. Gross return is higher.
Okay, wow, just amazing. Just like me, you initially had an engineering background. So can you quickly tell us from your study to the management of your two funds, your story?
That is actually quite a long story, so I need to cut it a little bit short. But yes, like you said, I do have an engineering background, and at the time I was working for Nokia for the mobile phone division, and I was writing software. And I got to my head that I really need to get deeper into investing if I ever want to accumulate some kind of a wealth. And as you know, equities are the best performing asset class in the world as there can be. And what I started to do was that I started writing a blog. The blog is in Finnish, but anyways, I started to write down my journey. And whatever I learned, I shared with others in the blog in this way. And so I got to dig into deeper and deeper into investing, and also into different kind of investment styles like value investing, different kind of growth investing styles, and so on. One point then, what happened was that I wanted to deepen my understanding even more. So while I was working, I was also attending university and studying finance there as well. So I learned and learned and learned, and I gathered so much information that I thought that now I need to pack this also somehow, which meant that I started a book project. I started writing a book. This book is about us, consumers, our spending habits, how we can change our spending habits to then, get a little bit more to the side. And when you have more to the side, then you can invest more money and it works more for you. It's like, this kind of a circle that just benefits and benefits and benefits more. So you can, in the end, live the kind of life what suits you. And that is so different for everybody as well. At the same time, I had been also developing the way how I was investing. And I was very deeply into value investing myself. And in this, I found a small niche, which is called quantitative value investing. It's like, if you combine engineering with the number crunching and so on, and then the passion for finance. So these kind of where the two different things meet and they come together. So that was like, man, this is really into my stuff, that I'm really into this kind of things, that I can crunch these numbers, I understand statistics and so on. So this is the way how I want to invest. And so I used first my own money into this. I was sharing it all in the public. Returns were very, very good. So I approached Helsinki Capital Partners that I have this kind of strategy that I've been developing, and we had the talks for 2 years actually with the management of the company, like how it can actually really work in a fund form. It's a totally different, like when you're managing only your own money and so on. Of course, they want to do their own due diligence, and Ernst & Young was also like verifying the track what I had, that it's actually really, I've been able to perform this kind of results as I was showing to them. And when there was also this book coming out, and then it was decided, okay, now it's a good time to then build the fund of this strategy what I had. So this is how I got started with Helsinki Capital Partners, and now then a few years back I started managing our second fund called HCP Focus. That is also equity fund, but there where this HCP Quant is on small and mid cap value equities, the focus is on large cap growth. So they are two very different kind of animals still in the equity space, yes, but they are very different kind of funds.
Okay, just very interesting. I'm also an engineer, and I had the same kind of studies. You know, when you learn, after that you begin to code and to screen the market, and the results are just huge, and it's so very interesting, and I love your approach, as you know. So we are both small caps owners. So can you explain why small caps are interesting in the economic environment like the one we are going into?
Yes, first of all, before going so much deeply into small caps, but about the current environment, we are in a down market, as everybody knows and realizes. And what happens in small caps in this kind of downturn environment is that they come down earlier than large cap equities. Like if you look at different kind of indices, and they are ruled by or run by larger cap equities in there, they have much more weight in the indices. So these large caps have been like carrying the market more, but if you look more like the small caps, they've been coming down much more. This is not like bad news in a sense that small caps also, they tend to bottom earlier. So although they have been now coming down a lot, that after they bottom, then you have a tendency that they go up much more than large caps. So this is one kind of opportunity, like, okay, we now know it's a little bit challenging times generally to be equity investor, but in small caps, because quite many of them, they're coming down so much, there's like a really good opportunities to find real gems and diamonds in this universe. And now we get also this other question, like why small caps are so interesting? Well, first of all, if you look at the large cap companies, like how many analysts they have behind them, just for one company, you might have tens or hundreds of different analysts. Then you go more lower, like in the market cap size of the companies, and the number of analysts just start to drop and drop and drop and drop, and in the end, you don't have any analysts following the company. What it of course then means that you have more possibilities to find this kind of companies that are undervalued, that valuation doesn't match what it should be. So then also when you look at amount of equities in this large cap universe and small cap universe, and the fact is most of the companies that are listed in the world stock markets, they are small and mid-size, which means there's a huge amount of these companies which are not analyzed that well. So it brings like a good pond where to go fish, you know.
Yeah.
So this is why small caps are very interesting. There's so much more competition in large cap space than small and mid cap space.
Very interesting. And for my audience, can you describe in details your stock selection process?
Yes, if we are talking about this HCP Quant fund, which is an in small cap value equities,
Yeah.
we start to narrow first our universe. So we put limits like what is the lowest market cap, what we can accept, and also because we need to narrow it that it doesn't go to large cap. We want it to be in a small and mid cap. So we put the like upper limit as well. We start from 100 million euros and we stop to 10 billion, which is in the United States, like the upper cap of mid cap equities. So that is the first thing what we do. Then also we have a quantitative systematic approach, and we are using different kind of quantitative metrics. Quite often, using these metrics, we need to exclude certain sectors, and what we do exclude is utilities and financials, because those the balance sheet structure is different comparing to quite many other sectors what is out there. We also look what is the average turnover, what is traded in a stock market for the company, and the reason for that is we want to take our position in a reasonable amount of time, which I usually want to form in about 5 business days. And also, like, if we need to sell, which we do also need to do from time to time, that I want to have reasonable time to get rid of the stock as well. So this put certain kind of constraints already in the selection process. Then after this, we go more into what I would call maybe this juicy stuff, what maybe you over there is more interested to hear. Like,
Sure.
one of these quantitative metrics what we use is Piotroski F Score, with a 9-point scoring system. It's kind of simple because it's a binary. So either the company fulfills one criteria or doesn't. If it doesn't, it gets a 0. If it does, then it gets a 1 point. And in the end, you add all these 9 points together, and from Piotroski's point of view, bad company is something what has a low score, meaning like from 0 to 3.
I made a video about Piotroski F Score, and I will put it on the description to get it maybe more understandable for those who don't know this style of quantitative criteria.
Good.
So.
Yeah. And so we are interested of those which are there on the high end from 7 to 9. Then also, because Piotroski is like, it's quantitative system, so and you're taking from, you know, income statements and balance sheets and so on, where you take the numbers. So you need to trust that these numbers what you are using, that they are real, that they are not falsified or fraudulent and so on.
So Beinish.
Yes. So one what we use to tackle this problem is that we are using Beinish M Score for this. That gives us some kind of probabilistic framework to know that is it like a high probability that this company is fraudulent with reporting, or it's like, okay, it's good to go, we can trust these numbers. So naturally, if it flags, we put it to the side, we can't invest into it. We also use momentum. There's a few reasons behind that. One of them is, of course, that it boosts the returns. Also, that kind of leads to higher turnover in the fund as well. And also, it doesn't correlate with the value investing principles that well. So it actually gives, because we are concentrated, so it gives us more diversification benefits, even though having a more concentrated fund as well.
What is the benefits and the risk of adding a momentum to a value-oriented strategy?
Yeah, exactly that. First of all, it gives this diversification benefits, because they tend to go a little bit in different ways, meaning that in different times usually momentum works, and at different times value investing works.
Okay.
And there are different ways actually to combine these two. I'm using so that that the stock needs to have a good momentum behind it. When you then actually look this company a little bit more detail, what you quite often find is that there has been some kind of catalyst which have been activating inside the company, so which have been turning it around. So for me, it's one way to try to avoid so-called value traps. So, you know, the value trap is that the company's stock price keeps on going down and down and down, and it never goes up. So this is something what it does. So it gives diversification benefits. Also, it boosts returns. Like if you backtest value investment strategies and if you include momentum investing into it, you usually get the higher annualized returns when you test it for a long enough time frame. And like I said, there are different ways to do this. I combine it so that the company needs to be having a high momentum in it, but you can also have it like a separate. You have like a split that you have a purely momentum stocks and you have purely value stocks, and that as well gives you diversification benefits as well. So this is something what many value investors they don't like momentum, but I'm telling you, look into it and be open-minded.
Very interesting and we as investor, we need to be open-minded. And when I met you the first time and when you shared me this point of your strategy, I was like shocked, but it's so interesting. And I will be sure backtest it.
Yeah, I'm sure. And then you can share with your audience like what your returns you are getting. But yes, also with the momentum is like the downside is that momentum strategies have a tendency to go back or mean revert. Mean revert is the right word to use in here, because nothing goes to the moon. So they have a tendency so that they snap, which means like there's a phenomenon called momentum crash, that this is something that goes up and then suddenly you come down with the elevator style. You know, you go up with the stairs and you go down with the elevator. Because it does mean revert, after about, when you backtest, you will see that if you hold a high momentum stock too long, it will start to deteriorate the returns what you are backtesting. So you need to that's why you need to have a turnover inside your strategy. So you ride with the momentum, but you can't ride too long time because it then snaps down. So that leads to then this higher turnover than what usually value strategies have. Because, you know, if you are like this Buffett style value investor that you want to find these cigar butts, you might be holding them for many years. But in this quant fund, because we are utilizing momentum, we are then forced to have a higher turnover in the fund.
This brings us to the question of your portfolio management strategy with this 6 months of position. And so yeah, what is your portfolio management strategy? You talk about diversification, how many stocks, when did you sell, when did you buy, etc.
Yes, like I said, we are very concentrated as a fund, so we would like to hold between 20 to 30 stocks in the fund, so we can then have really like a heavy weight on value and especially small cap value in this matter. Then this momentum brings that this turnover. So usually I hold for the position 6 months. If after 6 months it still fulfills my investment criteria, then it keeps on going longer. And usually like there's like 2, 3 this kind of stocks that they keep on going longer than 6 months. Also what I do is I use stop loss. I'm using a minus 20% stop loss. So if it doesn't work, if the momentum doesn't work, if the company doesn't perform in a price wise, so then I sell it, and then I again take another one from the list. So these are few things what I'm doing there. Also that I don't try to time the market. This is very important, and that's why I've been building inside the fund so that I would be having every month about the same amount of stocks that I sell and then replace with the new ones.
You said I'm not timing the market, but how do you evaluate the intrinsic value of your stocks to time a position?
I don't time. This is one thing. Like and also in this other fund, I don't time there either. Yeah. So what happens is, of course, because in different times and different kind of styles perform better than the others, and we have two equity funds. The other one is in large cap, the other one is small cap, the other one is value stocks, the other one is growth stocks. So they perform in different times. So when the cycle turns, like now it has turned with the growth investing and value investing, then it's up to the client, in our case, to make the switch. If they want to, you know, have this kind of a view that now value is the way to go, then they can switch from the other fund to the other one. And when they see that, okay, now value is not performing, then it's better that I take more of this other fund. So they are complementing each other. And quite often for our clients, we recommend that, how about you take both? Because then you get lots of diversification, and maybe the ride isn't that bumpy as it might otherwise well be.
Yeah, very interesting. And from this question of cycle, what importance do you give to the economic events as the rising of interest rates, inflation, war today, as we are in Estonia?
Luckily not in war in Estonia,
Yeah,
but the world in Ukraine. And so
we are close to Russia.
Yes, unfortunately too close to Russia, yes. Well, because I'm doing in a systematic way in this quant fund, so I don't put weight in there. But what it does do, like what we know, that when interest rates are rising, that's usually not good for growth stocks, because with growth companies, you have the income stream, cash flow coming, who knows, after how many years, maybe 10 years or so. And according to, if you are academic background and doing your discounted cash flow analysis and so on, it means that if you are using a higher discount rate, then it's not that valuable today, now that cash flow is somewhere in the future. And then on the other hand, usually these value companies, they generate cash flow today, and quite often they are having really good cash flow. So now in these times, investors, they value, you know, to get the good money today than having this, who knows what kind of probabilities there is that after 10 years you'll be having a good cash flow from this high growth company. So these affect these cycles and everything. So I already saw, like it started in year 2020, that the rotation started, that value stocks, they started to come more like interesting and up from there. And as you know, market usually they have a tendency to look forward like half a year or 1 year or so. And you know what we now know, in 2021 the interest rates started raising, so it worked. Yeah, market was right. They was guessing that interest rate will start going up, so value stocks started performing better. Now then we got all these other like events which are even encouraging even more this value investment style. And of course I'm telling what caused by the war and the bottlenecks to energy prices and everything, which is causing now higher inflation, and which leads to that the central banks are raising their interest rates, and you know it's all much more better for value stocks than growth stocks, even though equities have been generally coming down, but still you better be in value stocks in these days than in growth stocks.
Important to know. And you have invested as a private investor at start, and now you are like a hedge fund, you are like a fund manager. What's the main differences?
Well, first of all, is like the flexibility what a private investor can have. Quite often, as well in my case too, there's a mandate. There's like a certain rules and limitations what I can do. Like in this quant fund, I'm only limited to value stocks that fulfill these certain criteria, what's being put in there. I cannot take any other opportunities, even though I would see them, I can take part of them. Not in the fund. Of course, privately I could do, but it's better that I just manage the fund, so I don't mix the business and all this together. Same goes with the other fund as well. So there are certain benefits, especially for a private investor compared to big investor like fund managers like me also, because when you're a private investor, usually you are managing also a small amount of money. And you are not limited by different
liquidity and
yes, exactly. Yeah. So you can go even smaller size companies, but there also it's good to remember that usually you want to have enough of turnover in the stock in exchange, because otherwise usually the bigger investors are not also interested of that, and so on. But as a private investor, you can move much more faster. Whereas a fund, it might take several days for you to take a position. Yeah. A private investor, you got it. You put it limit order or whatever, and you got it. It's fulfilled immediately.
Private investor can take advantage of a few events.
Yes, there are different kind of anomalies which private investors can use, which are out of reach for institutional investors or fund managers or any who's managing like a lot of money. Well, first of all, like private investors, because they can move really fast. Like when you are managing more money, taking in the position takes time. When you are getting rid of the position, it takes time. And one anomaly in this field, what I can mention, is so-called PEAD, which is a short for post-earnings announcement drift. What this means is that when a company reports a good result, there's a tendency that the stock market will keep on going up, and if the report was bad, then it has a tendency to go down. And this is of course because big investors, they are either loading the stock, which takes many days for them as a group, or when they are unloading, it takes days as well. So the private investor, they can take the position like this, you have it as soon as possible after the report, after you have analyzed it, and you can then hold it for a few days. I think the anomaly was like 5 to 7 days or something like that. And then you can unload it, and you can kind of have the over profit from this one.
So do you have like other anomaly that can help my audience to invest?
Yeah, I mentioned this PEAD is like one anomaly what private investors can use. Then another one what could be maybe interesting is spin-offs. Like usually there's like a bigger company that spins off the smaller sub-entity from the company. And then we are going back again, like how for example, funds operate. Like I, for example, have a certain kind of criteria what kind of companies I can own. So in many cases, when these spin off something small, it might be like if you are like a large cap fund, you're not allowed to own this kind of small spin-off company. Or maybe it's in a different kind of working in a different kind of sector which you cannot own as a fund. And that leads to a situation when there are these spin-offs that funds and some other big investors, they are forced to sell this position away. They got it because they were owning this bigger entity. Now they don't want to own this more, but they get it. They get it still, and they are unloading it, and they don't care about the price because they just can't have it on the sheet. So they need to get rid of this line. And this also these special situations where smaller investors can find profit. Like usually when you buy a little bit after it has spinned off, because there's this more like sell pressure to this company, and then you take the position, and if I remember correctly, if you hold it like a 1 or 2 years, you usually get a better return than the market, for example.
Even spin-off indexes have a huge return. It's very interesting to look at, yeah. And for those who begin, can you describe your main maybe investment mistakes that you did and what you learned from them?
Yes, of course, I had tons of mistakes, like every investor.
Yeah.
And this is something that nobody can get kind of too harsh for themselves also, because we all do mistakes when we are investing, and we just need to learn from it and need to accept that these kind of things happen. Well, probably one of the worst, what I did, like when I was still really young myself, in my 20s, and I was just starting to invest with my own money. Like I was still studying, I was at the same time having summer jobs and saved a little bit. And I was putting money into IPOs and so on. It was like a tech boom time those days, and of course I could easily pocket the money because everything was going up so easily those days. And I somehow thought, okay, I'm such a good investor, and now I'm gonna start day trading. That I ended my day job and went to day trading. Do not day trade. So it's like 99% of the day traders they either lose money or they can't match what the market's actually giving them. And this is what happened to me as well. So I traded what I had then. I lost all the money what I had then, but okay, it was still a good experience because that also gave me more this kind of a thing that, dude, you are not that smart as you think. You need to educate yourself. So that's after that when I started really like reading books, educating myself. A few years later after that, started writing the blog and sharing stuff, and so it was me being too cocky, thinking that I know much more than the others also. But it's been proven that trying to trade, making good profits, is extremely hard. There are people who are able to do it, but most likely it's not you. So this is one. Maybe then like later what's been coming is like the holding on to these losing stocks for too long. So it's better to cut your losses early and just let your profits run. That's maybe a good advice too.
Okay, very interesting. As you know, personally, I'm just doing like consulting and I'm just producing software as I'm not a fund. So for those who want to fully delegate the management of their assets, what should they do?
Well, there are different kind of things what they can do. Well, if they are not interested of investing at all, then of course it's good to find a portfolio manager or asset manager like us, for example, who can look after for their assets. In the end, it's of course always like how the person wants the assets to be managed. That does it match with the manager as well? Like managers have
strategy.
Different strategy also, and all these kind of things. So it's about finding the right kind of match personally, and of course like the strategy what's been executed that it fits you.
Risks.
Yeah. So we, for example, we have 4 different funds what we manage, and everybody can go check is it like something what interests them, and if it looks like it's interesting for them, suits their purpose, and good, reach out, and then we look onward from there.
Okay. For those who want to reach out, I will maybe put a form on the description of the video, and with your check for the compliance, of course.
Yeah.
And finally, you had a look on my screener. Would you recommend value investing screener to find good stocks? And would you recommend screener as a tool to invest?
Yes, absolutely. I think like Remy, your screener looks fantastic. Especially like this more graphical approach what you have compared to many other screeners out there. I really love it. And screeners, especially in small and mid-cap space, I do recommend, because like I said, the whole universe is so large. There's like tens of thousands of companies. Like if you want to, without a screener, how you stumble up to the best opportunities, it's pretty impossible. There's all the time companies are reporting new information. There's coming a new quarterly reports where you have the new numbers. Like you can't, as a human, process that much of information. It's impossible. So you need to use some kind of tools to narrow your search, to find like where do you want to go. Is it like a certain kind of sector where your own expertise is that you want to look more closely, or is it certain kind of value investment style, for example? Are you looking for those who have high dividend yield or whatever? So these tools are excellent so that you can narrow your search, and after then you can start doing your own due diligence of these companies and find the real gems from there. It is impossible without this.
All right. Thank you for coming. Thank you for being here. Thank you for you to have had a look on this video. It was a pleasure to have you on this channel and to meet you again. Do you have a last word for the end of this video?
Make good investment decisions.
This is a good one. Bye.
Thank you, Remy. Bye.